Hi, welcome to the inventory lower of cost or market. This is a basic use of inventory, or excuse me, the lower of cost or market. So disclaimer and copyright notice, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you do decide to modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. So why are we talking about today about the lower of cost or market? And I want you to kind of step back and really think about what is the purpose of our financial statements. And it's really to give the investor, a very relevant and reliable picture in terms of where our numbers are. When an investor opens up our balance sheet, right, they're going to be looking at different items. For instance, if the company is showing a certain dollar amount in cash, there's an assumption that, well, the company actually has that cash, right? Cash is cash. For accounts receivable, right, when we're showing accounts receivable on our financial statements, you're going to usually see something where it will say accounts receivable net. And why is it net? Because that net amount is what we're expecting to receive from our customers. So typically for accounts receivable, we're going to use an allowance for doubtful accounts to get our accounts receivable to reflect what we expect to ultimately receive from our customers. For marketable securities, we're going to generally be reporting these at the current market price. There are some exceptions to that, but that's really how we go through and do it. And then lastly, for inventory, we're going to be reporting our inventory at the lower of cost or market. And this is really important and kind of, why is this so important to do? We want to make sure that the value of our inventory is not overstated. Rather, we want to make sure that our inventory reflects what we paid for that inventory, or if the market value of that inventory is lower, we need to reflect that market value instead of the cost. And here's an example, right? So Retailed Inc. purchases 20,000 iPhone 3s back in 2008 for $250 each, for a total cost of $5 million. Now, before to 2020, what if Retailed Inc. still had these on their books at $5 million, right? But the value of these phones are now about 100 grand if you're lucky. What's the problem here? Well, the problem is if we just left inventory at its original cost, and again, this is inventory that has not sold. But then over here, if the market value of that inventory over here is $100,000, we have a problem because we're signing off. So management's creating financial statements. And if they're showing a value here of $5 million on the financial statements, but the market value of that inventory is $100,000, that sounds like some fun federal jail time, which we don't want to do. And what we're really looking at here is that if we don't adjust inventory to market, okay, then we're looking at problems because inventory can be overstated, and that's not something that we would want to be doing. So how do we go through and use lower of cost or market? By the way, and again, I use this as a very extreme example, and mainly because companies are required to adjust their financials to the lower of cost or market. But I was just kind of using this here as like, well, what if they bought the inventory, they never sold it, and we're at today, and this is how much it's worth. So this is really the problem, and also another reason why we need to get rid of our inventory quickly. So when we're looking at inventory, we're going to use this rule called the lower of cost or market. Now, how do we apply lower of cost or market? Well, first off, we have to define how we're going to be using the lower of cost or market. There are three different ways we can do it. We can look at each inventory item individually. Now, if you have the technology and this makes a lot of sense, that might be great, okay? However, when we're going through, that's one way we could do it. Again, does the company have the capability? Do you have millions of items? Do you have thousands of items? How realistic is this? The next one is to look at categories or basically inventory. And for example, so instead of looking at each item individually, we could be looking at items in terms of groups. An auto repair store could be looking at classes. They could look at the tires as a group, the oils and the lubricants, the replacement parts. They could be each looking at those in terms of separate categories. They could be comparing the total cost of those items to what the market is. Then the one below this is when we're looking at the inventory as a whole. For example, if I have oil and basically if I'm a refinery and I have oil that is sitting in huge vats, that's not really looking at anything really individually as I'm looking at everything as a group. So the first thing we want to try to do is saying, well, how are we going to apply the lower of cost or market? Do I apply it to each inventory item individually? Okay. Am I going to be looking at categories? And then am I going to be looking at the inventory as a whole? And again, why is it so important? For us to be giving information to our investors, right? We need to make sure that the inventory is being reported the lower of cost or market. And here, right here, if the market value is only 100, but it's on our books for 5 million, we have a huge problem. It needs to be reflecting this or our inventory is being overstated. And part of the where I got this LCM definition was from this Accounting Tools article, and I'll be posting that to the bottom of the YouTube video so you can check that out. Okay, so we've figured out our categories. Now we need to figure out, well, what exactly is market? Okay, so if you're taking one of my lower division financial accounting courses, like so at Irvine Valley College, that would be Accounting 1A, I'm going to be giving you the market value, that period. I'll say, here's the cost and here's the market. However, if you're taking an intermediate accounting course, market becomes a little bit more tricky. And when you're looking at market, right, you have to go through and define or determine that market value by looking at that middle value between the following three items. The first one is going to be, or how do we define market, it is the middle value of replacement costs, the net realizable value, and then the net realizable value minus a normal profit margin. And whatever the middle of these values are is going to be your market value. And if we look at this here, and you'll see sometimes in textbooks, and I kind of pasted one of them down here, this is more for the definition of net realizable value, but when you're looking at market, they'll say, oh, net realizable value, this is the ceiling. This is the most amount that inventory can be reported at. And then they'll say, well, the floor is net realizable value minus a normal profit margin. If we end up choosing the middle value of these three, we're essentially going to be following the same rule. So for example, if replacement cost is higher, then basically if this is the highest of the three values, then my net realizable value becomes my market. If the replacement cost is between these two values, then my replacement cost becomes my market. If the replacement costs are below the net realizable value minus a normal profit margin, then this, what they call a floor, ends up being my middle value. So if you're taking intermediate accounting, or you're just trying to see what this is, then market's going to be defined as the middle of these three values. What is net realizable value? It's the selling price of the inventory less any cost to sell, complete, or dispose. And thank you again to the accounting coach for giving me that definition right there. So when we're looking at net realizable value, that's what this is referring to here. But again, if you're taking my class, for example, if you're taking a financial accounting class with me, then hey, I'm going to give you the market value and then you're going to be good to go. Okay. So now once we figure out the lower of cost or market, then what do we do? Well, if the inventory needs to be adjusted, meaning that when I look at this on an overall basis, the market is going to be below cost for different items, then I have to make an adjustment to my inventory. There are two different ways I can go about and do this. The first one is going through and saying, okay, If the amount is immaterial in terms of being as a percentage of cost of goods sold, I can simply take cost of goods sold and credit inventory or an allowance to reduce inventory to market. And why am I just putting it to cost of goods sold? Well, if the amount is not significant, okay, meaning that, and sometimes people use different thresholds, it's going to be very situational. A lot of people will say something like 5%, some people will say 1%, again, depends on the situation. The reason why the materiality becomes really important, because again, going back to the investor's perspective, when the investor sees sales minus cost of goods sold equals gross profit, what does an investor think about when they see cost of goods sold? Well, it was a cost of that inventory to me. They're not thinking that an inventory write-down is being buried in cost of goods sold. But if it's immaterial, we can put it to cost of goods sold. Again, materiality is key. We're not talking about genes or some other things. We're talking about materiality, meaning would it make a difference to an investor? Over here. The second one is that if the amount is material as a percentage of cost of goods sold, you would want to segregate this out as an investor. Again, this investor looks at cost of goods sold as what did it cost me to sell, or to basically, if I have sales, what did that inventory cost me that related to that sale? So in this case here, what I'm going to do is I'm going to highlight this as a loss due to inventory obsolescence or decline in market value. I would come up with an account that would really be a loss. And then over here, I could be using over here as an allowance to reduce the inventory to market, which would basically, I may not want to just credit inventory just in terms of keeping track of things. It might be better for me to use a contra asset account such as this allowance. But that's really the key difference. If it's immaterial, I put it to cost of goods sold. If it is material, I'm going to put this as a loss due to inventory obsolescence. Okay. So now we're going to get to our example and we'll work through this. So we've got Joe Inc. or Joy has the following inventory balances as of December 31st, 2021. So here they've got their inventory item, the quantity, the cost per unit, and then the market rate per unit. And then over here for Joy, determine the amount of the adjustment needed to adjust inventory to the lower of cost or market and prepare the appropriate journal entry. So what we're going to do right now is I'm going to jump over to the Excel sheet so we can kind of take this problem from there. Just give me a moment. Okay, and we're back. Okay, so we've got this question over here, which basically talks about Joy Inc. Had the following, or Joy had the following inventory balances as of December 31st, 2021. And then it goes down here. So the first thing we need to do is like, how do we go through and show here that our inventory is going to be at the lower of cost or market? So because I'm doing this on an individual item basis, I'm not going to do it in groups or as like one big category. What I'm going to do here first is figure out is the cost is market is cost greater than market. Okay. And so here, basically cost is greater than market, right? So my 20 is greater than 9. And so the answer is yes, I need an adjustment. Okay. So right over here, if cost is cost greater than market, if it is, I'm going to need an adjustment. Let's go through these here. Is cost greater than market? Well, the answer here is no, because my cost is $30 per unit, which is less than 35. So no adjustment needed. Okay. Over here for reefs, my cost per unit is 28. My market is 23. Is my cost greater than market? The answer is yes. I need an adjustment. Okay. Over here for shores, my cost per unit is 18, my market is 25. The answer here is no, I do not need an adjustment. Over here for stars, because my cost is 17, which is above market, right? My cost is bigger than market, I'm going to need an adjustment. Remember, I have to show inventory at the lower of cost or market. Right now, my inventory is here on my books at this value. This is the market rate per unit. Lastly, I get over here, my cost is greater than my market value, so I need an adjustment. Okay, so what's going to happen here is for clams, okay? And then also over here for Shores, okay? I don't need to do anything. Why do I not need to do anything? Because the inventory is already at the lower of cost or market, right? I do not need to do anything with these. So, but what do I need to do here? Well, what I need to figure out is what is going to be the adjustment that I'm going to need to do. So we're going to give ourselves a little bit more room. Okay. So if I need an adjustment, I'm going to take over here the difference based between cost and market. Okay. So I'm going to take over here. And this is going to be my difference between cost and market per unit. Okay. And so what I'm going to do here is that if I need an adjustment, right? Only if I need an adjustment am I going to go through and do this, right? So over here, my cost is 20, my market is 19. So the amount of adjustment per unit I'm going to need is $1. Over here, the amount of adjustment I need is on a per unit basis is going to be $5, or the difference between 28 and 23. Here, my difference is going to be $7, or the difference between 17 and 10. And lastly, here for Moons, my adjustment here is going to be $2 per unit. Okay. So now what I've figured out here is, because again, my goal is I need my inventory for these non-highlighted items, right? I need to be showing my inventory at $19. I need to show it at the lower of cost or market. Okay, again, this is for a lower division financial accounting class. I give you the market value, right? We're not doing replacement cost versus net realizable value minus a normal profit margin or net realizable value. I'm giving you the market, okay? So this is on a per unit basis. However, this is on a per unit basis. This is not the same as the amount of my adjustment. To get to my adjustment, what I'm going to need to do is I'm going to need to take the quantity and multiply it by the difference. So here I'm going to take 5,000 times $1 or $5,000. So this is going to be 5,000 times 1. Here for the reefs, I have 30,000 and my per unit adjustment is $5. So this is going to be 30,000 units times $5 per unit. Over here for my stars, this is going to be 15,000 times 7, or 105,000, or 15,000 units times $7 per unit. And then lastly over here, I've got Moons of 12,000 times 2, or this will be 24,000. Okay. So now I've gone through, I've done this on an individual item basis. What I'm now going to do is I'm going to add up all of my items here. So the total amount of the adjustment that I need for my financial statements is going to be $284,000. So, okay, we're being asked for two different things. The first one over here is that now it comes to what journal entry should I do? So again, the total amount of my adjustment is $284,000. I got that by adding up the individuals for each item. So here I needed an adjustment of $5,000, $150,000, $105,000, and $24,000. So that's my total adjustment. So if cost of goods sold is 10 million, I basically, what do I do? So when we're talking about making the adjustment to the financial statements, this goes back to talking about when we're looking exactly at, well, what do we do here? Okay, what happens when we're going through and looking at cost of goods sold? I have two different inventory choices. The first one is that the amount is going to be immaterial, okay? And let's take a go through and take a look at this. So if the amount is going to be immaterial, sorry. So is this material or immaterial? Well, the way I'm going to figure this out is I'm going to take my adjustment amount, I'm going to divide it by total cost of goods sold. My total cost of goods sold is 10 million. And my amount of my lower of cost or market adjustment is 284,000. And so right here, as a percentage in terms of overall, it's roughly about 2.84%. Now, most of the times for materiality, you got to kind of creep up to around 5%. However, in this case, it's only 2%. It might be acceptable to do this. So because it's not really going to be making an impact on an investor in terms of cost of goods sold, what I'm going to do is for this situation, right? So if total cost of goods sold is 10 million, and this is situation A, B, and then C, I'm going to debit cost of goods sold, and then I'm going to be crediting either inventory or allowance to reduce inventory to lower of cost or market. Okay, so we'll make this a little bit smaller. Maybe you can say it all there. There we go, micro size. Okay, Ant-Man doing accounting. So right over here, my adjustment is I'm gonna have a debit over here for 284. My credit is gonna be for 284. And then here, lastly, I need a description. So my description is going to be to adjust inventory to the lower of cost or market. Now, again, why can I do this? Well, the adjustment is relatively immaterial to cost of goods sold. And again, some people might say that almost 3% is material. Here, we're just going to say, assume that it's not. So, but what if cost of goods sold is 500,000? So if my cost of goods sold is 500,000, and my adjustment really hasn't changed. The adjustment is 284,000. Okay, what happens when I go through and I divide these items through? Well, now the amount of the adjustment is about 56.8%. We have a problem, okay? And why do we have a problem? Because now this is material. If I'm an investor, and just think about this, and if I'm seeing, oh, right over here, we got 784,000 cost of goods sold, but of this amount, like roughly 36% is because of our write-down, because we purchased items that went down in value before we could sell them. That's not good. So what we're gonna do here is we're gonna go here and show 12/31/21, and this is going to be a loss due to inventory obsolescence. Okay, oh, I know I spelled that wrong. Okay, and then on my credit here is going to be my allowance to reduce inventory to the lower of cost or market. Now let's make these a little bit bigger so we can see the accounts in their glory. There we go. So over here, basically 284 and 284. And this is a really important distinction. And again, the description is going to be the same. And the reason why is that on the income statement, it's going from cost of goods sold, which is just kind of a normal item being seen on a financial statement, down to an other income or expense item on the balance sheet. And this is really why this is so important. And this kind of gets us to our last point here, is that if the accounts that you use to report the journal entry are different, explain why. And this is, you know, when I have a lot of my students kind of struggle in terms of when I'm asking them to give both quantitative or qualitative explanations. Well, a quantitative explanation would be something like this, because we're showing here that the adjustment relative to total cost of goods sold, this will be showing here as a percentage. So we're saying that over here, because that the amount of the adjustment is very minimal in terms of cost of goods sold, therefore I'm okay with putting this into cost of goods sold. However, because the amount is a total percentage, the amount of the adjustment as a percentage of cost of goods sold is so high, in this case right here, I can't put it to cost of goods sold because it would be misleading the investor. Remember, the investor thinks about cost of goods sold is what did that item, when you had a sale, what did that item actually cost to sell? So that's why over here, in terms of, in this case right here, we're going to have to put it to loss due to inventory obsolescence or a similar category. Again, it changes because the total amount of cost of goods sold is different. So that's that. And I wanted just to thank you again for coming and watching. Please don't forget to like and subscribe. And what I will try to do is post this question, but with the twist in terms of having it as determining that market value between that middle value, between replacement cost, net realizable value, and the net realizable value less a normal profit margin. Have a great one, and I will see you on the next video. Thanks so much.